Hello everybody and welcome to this CMC Monthly Insights video where we take a look at the markets in the month that's passed and take a look forward then at what might happen in the month to come. My name's Rick Spooner and in this video I'm going to review the Asia Pacific region markets. I think it's fair to say that March was one of those months, as often happens in our region, where probably we were dominated by what happened elsewhere, and in particular this month I think by what was going on in the US markets. Our markets were heavily influenced by the global anticipation and then reaction to both the US Federal Reserve's rate hike and by the Trump administration's failure to pass its healthcare reforms. In the final analysis though, generally speaking, markets have finished the month on a pretty positive note, and certainly that applies to most of the equity markets which have ended up with a fairly solid gain in the month of March. Looking at the economic data in our time zone over the month, I think it's fair to say that this was one of those months where the data was mixed and probably there weren't any really major fundamental changes in market outlooks on any of the major economies in the Asia Pacific region. But just to review some of the highlights, I think looking firstly at the Australian economy, one of the big numbers for us was the release of our GDP data for the December quarter. That was quite a bit stronger than expected. It was up 1.1% for the month and 2.4% for the year. Part of all that also revealed a very strong increase in Australia's terms of trade, which is the price we receive for our exports compared to the price we have to pay for our imports. And that flows into national income as opposed to GDP, which is about the volume of our outputs. And we did have a very strong increase in national income, up 5.4%. That in turn allowed a solid increase in consumption in the Australian economy in the December quarter, up 2.9%, and very strong increases in corporate or company profits, which were up 20% on the previous year. What it hasn't yet done though, unfortunately, is to flow through significantly in any way to wage growth, which remains pretty soft. And indeed, one of the other highlight figures of the month was our employment market and unemployment figure. And again, that was soft, going backwards a bit last month with a loss of 6,200 jobs and the unemployment rate ticking up to 5.9%. This remains a source of concern for the Reserve Bank and is one of the key reasons that they are firmly on hold at this stage with interest rates. Finally, of course, we had the Cyclone Debbie in the north of Australia at the end of this month. Now that's not a market event at this stage, but it is likely to have a significant effect in the months to come. It will lead to very substantial increases in fruit and vegetable prices and have an upward influence on inflation and the basic headline consumer price index number. Looking at New Zealand, I think the GDP figure was probably also the highlight of their data as well. There it was the opposite to Australia. The number was a bit weaker than expected, growing only 2.7% for the year compared to an expected 3.5, compared to 3.5 previously and an expected 3.1%. But the markets generally looked through that. A Kiwi dollar, in fact, rose quite strongly in the days after the release of the GDP data, and I think that's largely about it being driven lower by temporary factors such as particularly weather-related factors. In China, I think probably the main event for March was the People's Congress, where the Chinese government does its economic planning, or at least announces a lot of its economic plans and forecasts and targets. And there it did exactly what had been widely anticipated and set a GDP forecast for the coming year of 6.5%. Now that's down a little bit on the previous year where it had a forecast range of 6.5 to 7%. But despite the fact that it's a little bit softer, most people anticipate that they'll meet that. That will require some stimulus on their part, but it's highly likely that they will continue stimulating the economy and achieving that target in the lead up to their very important political event at the end of the year, which is the new appointments to the Politburo. And that in turn will mean ongoing support, I think, for other international commodities, particularly in Australia, for commodity prices with an ongoing program of infrastructure and other development. And lastly, I think on the review, one of the important things in commodities in our time zone was that the iron ore price finally began to give up some ground, falling from a peak of $95 in late February down to the low 80s in a trend that some believe may go further, and that has already been reflected in a significant sell-off in Australian mining stocks. Well, to look back at how all that impacted on some of the charts that we looked at in our last monthly Insight Review, let's begin with the Australia 200 Index. And I think that what we'd outlined there was that there was a key and well-developed support and resistance for the Australia 200. I had suggested that if we fell to the support, that might be a good buying opportunity, and if we broke below it, we could go deeper. In the event neither of those things happened, we went up to test the resistance again, and then finally to break well above that resistance in the last few days of March, which is a healthy development. And I think now, looking at the landscape of this chart, that old resistance line that applied this year is now the first initial support for the Australia 200 in the around about the 5830 to 5800 zone. Another chart I think that we looked at last week and month, and which remains very interesting, is the Hong Kong H shares market. There I'd noted that there was quite significant divergence between price and the RSI indicator, suggesting possible weakness. That did play out. We broke below the support there in that market and actually did come back to the supports that we discussed last month, and in fact bounced neatly off the 61.8% retracement and went on to make new highs for there. And that also is potentially an overall bullish development, although of course we could easily get pullbacks along the way. Another very interesting market from a charting point of view that we've been reviewing in these monthly insights is the Aussie dollar. Now the Aussie has remained within its well-defined resistance level as outlined on this chart here. It did back off it again this month, but came back neatly to a 61.8% retracement and has begun to rally. So the question for traders is whether or not we go on with it from here and do break through the resistance or not, or whether we're going to keep falling. That resistance that's operated now for quite a while currently cuts in at about 77.3 cents, but if we break up through it, then the highest peak in this resistance at around 78.4 might come into play. Looking to things on the downside, the initial support is just under 75 cents now at around 74.9 or 74.8, and a break below that would be a significant sign of weakness potentially for the Aussie dollar. So to have a look forward then at what might be some of the key events for the month of April, to begin with the Australian economy, I think things are in a state of real flux for our economy. Both the market and the RBA are really just waiting to see whether that big improvement in the terms of trade and the significant improvement we've seen in business conditions and business indices like the NAB business conditions and the PMI, manufacturing PMI, will start to flow through into the broader economy or not. So against that background, I think all the figures, headline figures in the Aussie economy really could have an impact on markets this month. Particularly keep an eye out for the employment data, which I think is due out on the 13th of April. But to select a couple of highlights potentially for the month of April, I think two things. One might be the CPI data. Now that's due on the 26th of April. Any real weakness there after some improvement last time could really put the Reserve Bank and the Aussie dollar on the back foot. And another thing is that sneaking into the early next month, we've got the federal budget on the 3rd of May. But traditionally the government, or in recent years, they've leaked most of the budget out a day at a time over the week or two before the budget is released in order to maximise the number of headlines they get. And so look for those to start coming through at the end of April, and they could be quite significant this time for markets. Things that could be focused on would be possible changes to tax relating to property, changes to capital gains and negative gearing, for example, or stamp duty and land tax, all of which could impact the market's thinking on bank stocks. And another possibility is changes to taxes on oil and gas stocks, which, if they are brought in, could be significant for some of the onshore gas producers like Woodside Petroleum. Turning to New Zealand, I think their CPI data will also potentially be a headline there. It's due for release on the 20th of April, and the market again, the New Zealand CPI is back over 1%, but 1.3%. But any weakness there could again have the market doubting whether the RBNZ will be able to hold rates neutral for a year or two, as they are suggesting they will. Now in China, trade data released on the 13th of April, and the big day for China will be the 17th of April. On that day we get the GDP for the March quarter, which will be a real focus for markets, as also will be the industrial production and retail sales data also delivered on that day. And finally, to round out, I just thought I'd review three markets that look particularly interesting to me and for the month ahead, and in terms of how their charts are performing at the moment. The first is the US dollar against the Singapore dollar. Now I've looked at this for the last couple of months because it formed that beautiful and pretty obvious Elliott wave 5-wave advance, meaning that we were likely to get a big correction, and that's exactly what we've had. And that correction has actually come back to the interesting retracement levels and now is parked at around the 50% retracement level. And as it waffles around this 50% retracement level, it does look as though it's potentially forming a 3 drives to a low pattern, a symmetrical 3 drives as I've got on the chart here. So if it was to bounce up from this level above near-term resistance, that would be quite constructive then, suggesting that the whole downward correction in the US dollar may be over. If that doesn't happen and this 3 drives doesn't complete, then something else to keep an eye on would be a move back to the 61.8% retracement and some form of sign of forming a base around that level as a potential buying point. My second chart is one of the cross rates. It's the euro against the New Zealand dollar. Now the interesting thing about this chart, I think, is that it has formed into a very neat terminal or rectangle type of a pattern, and the direction of the break out of this pattern could well tell the direction of the next trend. If it breaks up through the top of it, that could be bullish. If it breaks below it, and it could be close to doing that, that would be potentially bearish for a significant pullback. From a risk-reward point of view, the alternative I would be keenest on would be that if it bounced yet again off the support, found the resistance for a third time and fell away or rejected that resistance for a third time. That would provide an opportunity to sell with a close stop above the resistance, and then looking then for the market to come back and break below the support, which it often does after 3 touches of a resistance like this one. And lastly, I've got a stock chart, which I think is a key driver, obviously, for the Australia 200 and the Australian markets, which is the CBA, Commonwealth Bank. Now, as you can see, this has also arrived in the last couple of days of March at a potential resistance level, which also looks like a possible wedge or terminal pattern. Now, if it breaks straight through here in the next day or two and breaks clearly above it, then the wedge doesn't apply, and that's potentially bullish, not only for the CBA, but of course for the Australia 200, because the CBA is the biggest stock in the Australia 200. But if it does the opposite and begins to reject this and fall away from this line, I think that would really consolidate this wedge view of the CBA and would be potentially quite bearish, suggesting we might stay inside this wedge range and fall back down again to the supports, which could be a selling opportunity for those looking to short or take profits. You know, in that sort of scenario, it's a decent risk-reward thing, because the thing you're looking, if it's wrong, is to place your stop just above the resistance if things do pan out that way.